Hello everyone. So today we are going to discuss Unit 2 of OTHM Level 7 Diploma in Accounting and Finance. So today we will discuss the Unit 2, that is Corporate Reporting. First we have the first learning outcome, in which we will try to understand the accounting and finance regulatory framework. The first assessment criteria is to explain the main sources for regulatory framework. So we have two type of regulatory framework. The first one is the regulatory framework and financial reporting, and then we have reporting standard. If we talk about regulatory framework and financial reporting, then it ensures transparency, consistency, and comparability of financial information, and it protects stakeholder interest by providing accurate financial data. If we talk about reporting standard, then it sets the guideline for preparing and presenting the financial statement. For example, International Financial Reporting Standard, that is also called as IFRS, and Generally Accepted Accounting Principle, that is also called as GAAP. Now we have some framework and international standard. So first one is the principle based system, that is IFRS. It is flexible and allow professional judgment, and it focus on economic substances over a strict legal form. Then we have rule based system, that is GAP. It is specific and details guidelines, and it reduces ambiguity but can be rigid and complex. Then we have international financial reporting standard, IFRS. It is developed by the International Accounting Standard Board, IASB, and it aims to provide a global language for business affairs for better international comparability. Now we have the second assessment criterion, which evaluate the impact of the accounting and finance regulatory framework on business organizations. So we have different importance of the regulatory framework. First is that it provides guideline for transparency in financial reporting. Then it enhances trust and credibility with investor and stakeholder. Then it reduces risk of fraud and financial management. Now, there is some useful information provided by the business. The first is the growth and expansion strategy, which provide the reliable data for planning new market or acquisition. Then there is business decision, in which there are some accurate financial insights which drive the effective resource allocation. Then we have investment decision, in which there is clear comparable reports which attract global investors. Then there is impact on performance management and budgeting. So first we will discuss performance management. It is the regulatory framework that provide benchmarks for tracking progress. It helps in setting realistic KPIs based on accurate financial data. Then there is budget creation, in which there is financial reports guide resource allocation and expenditures planning, and it reduces waste and align budget with the strategic goals. Then there is the third assessment criteria, in which we assess areas of abuse and exploitation in accounting and financial reporting. So we have different origins of abuse and exploitation in accounting. First, there is historical context. So early accounting practices lacked standardization, creating loopholes. Then there is some financial information that was often manipulated to hide debts or inflate profit. Then we have document development, in which there is the introduction of ledgers and balance sheet aimed to provide clarity but were often falsified. Then there is manipulation of financial document was a common issue before modern framework. Now we have the development of early auditing system. So first is the auditing evolution, in which we initially focus on verifying such transactions. So as a business expanded, audit began examining broader financial statements. Then there is exploitation despite auditing, in which there is the lack of standardized procedures led to audit failures. Then there are some famous scandals like Enron, which highlight the persistent gaps in systems. Now we have the second learning outcome. Sorry, I have wrote here learning outcome 1, but this is actually learning outcome 2, in which we will try to understand the accounting concept, principle, and theories. So we have the first assessment criteria, in which we will try to explain key accounting concepts, principle, and theories. So we have the different key accounting concepts here. First, we have the accrual concept, then we have the prudence, then we have the materiality, then we have consistency, then we have going concern. After that, we have business entity concept, then we have money measurement. After that, we have duality, then we have stability, and at last, we have objectivity. Now we have the explanation of all these. First we have the accrual concept, in which we record income and expenses when they occur, not when the cash is exchanged. Then we have prudence, in which we avoid overstating assets or income. Then we have materiality, in which we focus on information that influence the decisions. Then we have consistency, which apply accounting method uniformly over time. And then we have going concern, in which we assumes the business will continue operating. Then we have business entity concept, in which there is separate business and personal finances. Then we have money measurement, in which we only record quantifiable uh, transactions. Then we have duality, in which every transaction affects two account, debit and credit. Then we have stability, which assume the currency purchasing. Then we have the stability sorry then we have the then we have the stability, which assume the currency's purchasing power is stable. Then we have the objectivity, in which we use evidence based unbiased financial data. So there is the importance. First is the that first importance is that, and it ensures the accuracy and consistency. Like it has some standardized method for reliable and financial reporting, and it builds stakeholder trust. For example, it promotes transparency and credibility. Then it supports decision making, like it provides the dependable data for planning and performance evaluation. Then it facilitates the compliance, which means it aligns with legal and ethical regulations like IFRS and GAAP. Then it enables global comparability, like it helps in multinational organization which presents uniform financial statements. Then it promotes business stability, in which it encourages the prudent and stable financial practices. So we have the first assessment criterion, which we prepare accounting information. Here is the cash flow statement, which is showing all the details and category details and amount. You can review it, and if you have any question, you can ask me. Now we have the group accounting and long-term contract. First, we have the group accounting, which means goodwill calculations and treatment. Then there is a non-controlling interest reporting. Then there is the intercompany transaction management. Then we have accounting for long-term contract, which means the recognition of revenue and cost over the time. Then there is the issue and redemption of share and debt, which is handling the share capital and changes and debt management. Now we have the second learning outcome, in which we interpret the published accounting information. So here is the statement of comprehensive income, in which we have the category and the amount. First we have the revenue, then we have cost of sale, we got gross profit by subtracting cost of sale from the revenue, and after that we have the operating expense, and we have the net income by subtracting the operating expenses from the gross profit. Now we have the interpretation of that income statement, which means that the company generated $120,000 in the revenue with the gross profit margin of approximately 41.67%. Then it has the operating expenses accounting for 12.5% of revenue, resulting in a net income of $35,000. So this indicates a healthy profit margin and controlled operating cost. Now we have the statement of financial position, that is balance sheet. It has two categories. It has total three categories: asset, liabilities, and equity. The asset sides must be equals to the sides of liability and owner's equity. So the interpretation of this previous balance sheet is that the company's asset exceeds its liabilities, giving the debt to equity ratio of 0.5. It indicates a strong financial position with significant owner's equity. The company has a good balance of asset and liability, which demonstrate the financial stability. Here is the cash flow statement. Cash flow statement has total three categories, that is operating activity, investing activity, and financing activities. If we talk about its interpretation, then if we talk about operating activities, then there is a positive cash flow of $30,000, which suggests the core business operations are profitable. Then there is the investing activities, which shows the negative cash flow of $10,000, which indicates the investment in asset which could support the future growth. Then there is the financial activities, which shows the positive cash flow of $20,000, which reflects the capital raised through the debt or equity, potentially for expansion or operational support. Then, if we talk about overall, then the company has a net increase in cash flow of $40,000, which indicates the strong liquidity and operational efficiency. Now we have the fourth learning outcome, in which we would be able to review the specific policies, practices, and regulations within the scope of corporate accounting. So we have the first assessment criteria, in which we explain specific policies, practices, and regulation within corporate accounting. So there are some accounting rules and regulations in corporate accounting. First, there are UK accounting standard, that is governed by the Financial Reporting Council, that is also called as FRC. It is based on International Financial Reporting Standard IFRS with specific UK adaptation. It ensures consistency, transparency, and compliance in financial reporting. Then we have Generally Accepted Accounting Principle, that is called as GAAP. It is the framework of accounting standard used in UK and globally. It ensures consistency and comparability of financial statements. It regulates how financial transactions, asset liabilities, and income are reported. Then there is the corporate accounting, which involves the preparation of key financial statements, balance sheet, income statement, and cash flow statement. It requires adherence to UK accounting standard and IFRS for accurate and compliant reporting. Now we have the second assessment criteria, in which we will try to assess the accounting regulation for a named business sector. So here is a preparation of company's financial final accounts and cash flow statements. So first we have the final accounts and key financial document reflecting the company's financial position at the end of the accounting period, includes balance sheet, income statement, profit and loss statement, and it must comply with the accounting standard and IFRS for accuracy and consistency. Then we have the cash flow statement, which reflects the movement of cash in and out of the company. It helps to assess the company's liquidity position and its ability to meet short-term obligations. It is a part of final account and essential for financial health assessment of the company. If we talk about its analysis and interpretation, then companies must perform financial analysis using key ratios such as profit margin, liquidity ratios, which is used by investor, creditors, and regulatory bodies to assess the financial health and make informed decision. If we talk about key element or amalgamations, then it is when two or more companies merge or acquire each other and significant changes occur in financial reporting. If we talk about amalgamation accounting, then it must follow specific guideline for transferring the assets, liability, and equity, and it must ensure correct reporting in financial statement post-merger or acquisition. Now we have the third assessment criteria, in which we will try to critically assess the accounting practices and policies identified for a named business sector. So there are some key accounting practices and policies. If we talk about the some methods used for financial calculation, then we have revenue, which is recorded when earned on accrual basis, not when cash is exchanged. Then we have expenses, in which we recognize when incurred, not when paid. Then we have depreciation, which means different methods are there to allocate the cost of tangible asset over the time. For example, there is accrual accounting, which means revenue and expenses are recorded when earned or incurred, providing a more accurate picture of a company's financial performance. Then we have some accounting policies, which is the principle basis convention rules and practices that are used in financial statements. Then there is inventory valuation. For example, there are some policies, that is FIFO and LIFO. FIFO means first in first out, which assumes that the oldest inventory is sold first. Then we have LIFO, that means last in first out, which assumes that the newest inventory is sold first. Then we have revenue recognition, in which is the method a company uses to determine when and how to recognize revenue from sales or services. If you have any question, please feel free to ask. Thank you.